Hello again, everyone. My name is Sarah Clark, and I am the Assistant Trade Show Manager here at CIPH. Welcome to today's Outlook Economic Forecast webinar presented by CIPH and HRAI. I'm pleased to note that we have just over 350 sites registered across Canada for today's session. Before I introduce our webinar presenter, please note that you will have the opportunity to ask questions at the end of today's session. You can do this by typing your question directly into the question box you see in the webinar control window on the right-hand side of your screen. Please save your questions for the Q&A portion at the end of the session. If you are having difficulty with the system, please click the raise hand icon and I will send you a personal message to help you out. Also note that a copy of today's presentation will be made available to all attendees following the webinar. You will have the opportunity to submit questions after the session has ended as well. Today's webinar presenter is Peter Norman. Peter is Vice President and Chief Economist at Altus Group. Altus Group produces a publication for CIPH and HRAI called the Outlook Quarterly Economic Review, which delivers timely economic insights, housing market data, and commentary and analysis of trends in non-residential and infrastructure investment by region in Canada. Peter is a well-known professional land economist and forecaster who is widely quoted in the Canadian media and is a frequent expert witness on economic matters. He also consults for private and public sector organizations across Canada, providing economic intelligence and strategic advice. Please welcome Peter Norman.
Well, thank you very much, Sarah, for that introduction, and thank you everybody for joining us on this call. It's another 6 months have passed. We all met up here in order to hear what my remarks were on the economy about 6 months ago. And at that point in time, I was reporting on what it was like 8 months into a pandemic. And now we are well past the 1 year point and still going strong, I suppose. So today I'm going to be kind of focusing my remarks as per normal on issues kind of affecting the economy, and in particular, obviously, the kind of recovery we're having, et cetera, and then talk about implications on the construction sector through kind of demand driver factors for both the non-residential and residential space. And perhaps along the way, we'll talk about a few other things as well. I'll just give Sarah had mentioned off the top about the publication. I'll just give you a bit of a reminder that here it is. I hope that you're still pulling it up every quarter and taking a look at it. We have a number of pages in there that kind of go through some regular indicators. Some of them are very regional focused, if that's what you're interested in, and some of them are national focused in order to give a broader context. We always have a kind of a qualitative economic review article on a different topic at the beginning. The most recent one, as you can see, is about new home sales and how they can be a great leading indicator for us understanding how things are going in the construction sector. I'm going to share a few kind of detailed remarks about that topic near the end of my presentation today. Just to kind of give you a little bit of a flavor for, some of the detailed stuff that we look at in terms of that kind of leading indicator. But as you can see on here, we've covered other topics such as oil price shock. Well before the global recession, we talked about the potential impact of a global recession, and we usually touch on ICI construction from time to time as well, which of course is all very important. One of the things that we present in the newsletter on a regular basis is our leading indicator. We developed this leading indicator for CIPH a number of years ago, and we continue to report it. It does tend to be a fairly telling indicator. We tend to pull together as much of the data points that we think give a good forward look on activity in the construction sector all together in one spot in order to try and give an idea about balance. And sometimes it's a bit higher and sometimes it's a bit lower than, as you can see. Now, we've just come through 2 quarters where this leading indicator is actually quite strong, which of course is reflective of economic the path of economic conditions. In fact, two quarters quite strong after a quarter that was quite negative. In fact, both you can sort of see collectively those 3 quarters are lying way outside of the norm for this indicator over the many years that we've been tracking it. And I'll speak a little bit about that as well, but that's obviously indicative of the type of economy that we're looking at. And so just moving into the presentation material, I'll just say that there's kind of three kind of dominant themes. Now, on my cover slide, you might have saw that I titled this this presentation "Choppy Waters," which is a cautionary term. In fact, sometimes choppy waters can be a little bit frightening when you're in them and you're out in a boat, particularly a small boat. But they're not necessarily dangerous waters. They're choppy waters, and that's exactly the kind of economy that we're in right now. So the economic recovery from the recession that we had last year, the pandemic-induced recession, has been very, very strong, but it is uneven. It's uneven by sector, and it's showing uneven spurts and starts depending on the continued progression of the health crisis and the on again, off again containment measures brought in by various provincial governments to respond to the subsequent waves of threat from the health crisis. So it's an uneven recovery, even though on net it's very strong. Non-residential construction investment has been lagging. And it faces longer term challenges. So we're going to spend some time talking a little bit about that. And then on the residential side, housing demand, of course, is very buoyant. It has been very buoyant in recent months, and right the way across the country as well, which makes it kind of a unique time because we often have housing that's not always a national phenomenon. But the supply conditions are very tight and are posing severe risks and through various channels. So we'll talk a little bit about that as well as we weigh out what things are like in these choppy waters. I will say that very early on in this pandemic, I'm stealing this analogy from one of my colleagues, but that somebody used an analogy that the effect onto the economy of the pandemic is a little bit like taking a beach ball that's floating and then pulling it and holding it underwater. And that, of course, was the sharp downturn during the second quarter last year. And then, of course, releasing it. And of course, it floats up to the top of the surface of the water very quickly, and in fact overshoots. And then as it lands, you get a lot of splash, you get a lot of waves, and people get wet. So it's a recovery. But it's not always a recovery which is controlled, and it's not always one that's even. And we're in that period right now where there are a lot of waves and splash, and we're not fully out of those unusual conditions yet. Just going to start a little bit large, as I often do, in order to give you some context for the shape of economic growth going forward. And I'm showing you kind of IMF numbers for the world economy overall, way over on the left-hand side of your screen, and you can get a sense there about how the economy shrank an almost unprecedented over 3%, 3.3% for the world economy in all of 2020, which is a very dramatic decline. But that's being more than compensated for by the growth of about 6% this year. That's a forecast number, of course, but as it progresses through, there are expectations that that on a world basis that the pickup will make up for those declines. Of course, there's high uncertainty. Those are the words of the IMF itself, and we could see that number pushing off further into 2022, more in 2022 rather than 21, if in fact conditions, particularly as we're seeing emerge in India now and elsewhere, really put the brakes on the advancement in the global economy that we've seen in the last number of months. But nonetheless, this is the view right now, or at least sort of in March from the IMF, and I don't disagree with it. And you can sort of see that that's mirrored very much in the consensus outlook for the US economy, which you can see there, and of course my outlook for the Canadian economy, which you can see has a fairly similar shape, even though Canada's economic contraction last year was a lot more severe than we saw in the world economy as a whole, and more severe than the U.S. economy. And bear that in mind, much more severe. But that we're we're also participating in a fairly rapid bounce back this year. We expect growth to be around 6 to 6.2%. Now, over on the right-hand side, I'm sharing this kind of new view, which I think is a little bit indicative of the uncertainty of the forecast environment as we go through. This is just the IMF's forecast for this year, for 2021, and as they presented it at different forecast times. And you can see back in January 2020, this was prior to, well, at least prior to the pandemic being declared, although there was already knowledge that it may be coming. They had expectations of about 3.4% growth, which is pretty much a normal year of growth for the world economy. And then as we got into March and April with the severe contraction in 2020, their 2021 forecast was for quite rapid recovery, around 5.8%. And then as the length of the lockdowns, et cetera, kind of continued, they got more and more negative about growth this year. And then after October, once the vaccines were approved and starting to roll out, they got more positive about the growth for this year. So it does give some sense about how the expectations for economic growth and as how it's playing out very much for this economic growth this year and as we go forward, very much is dependent on the conditions in the health crisis itself, and of course, the emergence of the vaccines, the pace at which the vaccines are rolling out, and ultimately the effectiveness of those vaccines, which of course itself continues to be there's a small amount of unknown there in terms of the longevity with which those vaccines will work and how fast we'll be able to boost them and all that kind of thing. But right now there is a fair amount of optimism in terms of the way that it's rolling out worldwide and as the economy will move through this period. Now, just moving down into Canada a little bit, looking at the employment situation, this very much does also give an idea about how our recovery is shaping up. You see that sharp decline when we lost about 3 million jobs. Many of those jobs came back last summer. As you can see, job growth kind of peaked out in the fall, and then as we went into the second wave, things kind of deteriorated, and then they started to improve into March. Now, March is sort of the beginning of the third wave, and we'll probably see, as April data comes out later this week. This is a poorly timed presentation in that respect. We'll get April data in a couple of days. When April data comes out, we'll probably see that April took a step back again, just because of the emergence of more lockdowns across the country related to the third wave. But nonetheless, overall, at least to where we are right now, about 90% of those jobs that were lost have now been recovered. Of course, cautionary statement being that those last 10% are kind of the most difficult jobs to recover. They're the ones that won't come back until there's really a lot of normality in terms of the way that we in terms of the way that we can interact in our communities, and therefore the ability for those kind of high touch occupations like restaurants and bars, et cetera, and theaters, that they can all start coming back online fully. And then, of course, cautionary statement that we need to start consuming again in patterns that were similar to what we consumed before. And that still is a bit of a question as well. As an example, is our retail spending that we have successfully shifted very quickly to online retailing, will it at least partially or mostly reverse back to spending in our communities and in our stores and supporting those types of jobs? So we will see how that all plays out, but nonetheless, many of those jobs are now recovered. You can see that provincial, I'm not going to go through the provinces, but you can see that BC has certainly fared a lot better in terms of that net recovery, and the prairies probably the worst overall, along with kind of Quebec as well as not fared that well in terms of the pace of employment recovery. But everybody, that unevenness as well is characteristic of the unevenness to which the health crisis has affected various provinces. And just a slightly different view of GDP, just to give some idea, because that was a very general one. GDP is in addition to the employment numbers that we sort of talked about, and you can sort of see, those those strong gains in GDP were mostly last year, but we're still looking at relatively strong gains through at least the second half of this year on a quarterly basis, and the net effect on an annual basis will be that 6.2% that we talked about before. Coming back to jobs for a second, I just wanted to make one kind of stylized fact from this chart, and sorry if it's a tiny bit hard to interpret, but on the left-hand side, we're looking at the pace of employment growth month by month by month since the beginning of the pandemic. And I mean, it is what it is. It follows a little bit that pattern that I showed you in the more normal chart earlier. But on the right-hand side, I'm looking at the hours worked, the actual hours that people are working. So, you know, you could have employment decline a certain amount, but there have been times in this pandemic when the actual hours that were worked by individuals fell a lot more than employment, because people may still have been employed, but their hours were cut back. And conversely, during the recovery, you know, people gained hours who may not have even had lost their jobs originally. And so there's a lot more volatility on hours worked, and that plays to the increased volatility through this period that sometimes just those top line employment numbers don't, you know, kind of mask as well. So that's a kind of a stylized fact that I like to point out as well. And I just want to transition now into the construction sector and how the impacts are. So first, just to kind of get our bearing on things, on the right-hand side, I just want to kind of remind everybody of what composes the construction sector. The non-residential construction sector represents about 29% of construction investment in Canada, and the majority of that is commercial construction, which would be your office and retail primarily, entertainment facilities, stuff like that. So generally public serving types of facilities, and then you have industrial that plays a role, and institutional and government type construction as well plays a role. And then the rest of it, the 72% of construction spend is residential. Residential really is, you know, the lion's share of the construction sector. And at least in the view how I've kind of showed it here, it's relatively split between, you know, single detached units and multis. Later on, I tend to talk a little bit more about apartments versus single family, but this is a kind of a view that shows singles versus multis, and you can see it's generally split between those two. The renovation numbers are all baked into there. They end up being the biggest. Renovation ends up being the biggest part of those residential numbers. Overall, the residential the residential numbers are about 140, as you can see there, about 140 billion dollars, and it's closer to $80 billion, which is the renovation numbers that are embedded into there. So renovation, very important. Residential, very important. Within the non-residential sector, the commercial sector is the most important. Now, looking over on the left-hand side there, you can see the trend on commercial investment, where we saw, you know, a steady rise, a steady and healthy rise in commercial construction, particularly through the 2018-2019 period, and then it contracted modestly into 2020, perhaps not as much as you might expect, but it did contract kind of modestly there, at least on an overall basis. And then in the first quarter, we don't have the full first quarter data yet on here, but the first 2 months, which give us an idea about the first quarter, you can see there's even more of a contraction, almost a 14% contraction overall, and a lot of that is coming out of commercial. In fact, if I analyze commercial a little bit stronger here, you can see that the commercial, you know, the volatility on commercial is really driving that overall non-residential number. We're looking over on the left-hand side there. You can see that commercial construction in April fell a lot faster than overall non-residential. It also started to come back faster, but then when things started to turn down again for non-residential construction in general, after that kind of brief, you know, pent-up, you know, return to projects that happened after the initial lockdown, in general, we're seeing that commercial investment trending down over the last number of months. That of course, the lockdown, the decline in construction was simply because sites were closed in many cases for a number of weeks in many parts of the country, and then construction sites, and then that comeback, of course, were just those sites opening up and trying to make up some time, et cetera. That's why we saw that growth. And then really that trend decline in both in the an overall non-residential construction, but led by commercial construction, which is your offices and retail again, really coming from that kind of lack of confidence in terms of taking on new projects, delaying projects that were in the pipeline, delaying CapEx on existing buildings. The leasing activity is down, so the TI, the tenant improvements that go on inside office buildings has, that activity has obviously declined quite a bit because there aren't a lot of people moving into new office buildings or moving into new space in office buildings, et cetera. I just wanted to give a little bit of a view that there is a lot of office in the pipeline ready for construction. There is about 20 million square feet of office space in Canada right now under construction. Of course, we have some concerns right now about the viability of all that space, but generally speaking, once it's under construction, it's going to come to market. So we will have a situation where, somewhere around 20 million square feet will be coming to the market that's under construction now over the next several years. But there is some uncertainty as to the degree to which there'll be demand for that space, particularly as we're seeing some adjustments in terms of companies' need for space as they rethink how much of their workforce will be in the office at any given time. Now that remote working is so we've gone through a period when remote working has been the reality for most companies and a lot of government departments, and then as we move into that post-pandemic period, there's continued questions about how much of those trends might continue. I'll share a few points on that a little bit later, but in general, it's not going to be completely back to normal. It's going to be some other place in between. It's not going to be exactly the way it is now, and it's not going to be back to normal, but somewhere in between. But either way, I think we'll be kind of setting office demand back by, probably at least 5 years in many markets, and that's at a time when we have a lot of space coming to market. So we will see, things look rougher in terms of office space performance as all that new space comes to market and vacancy rates rise. I'm also pointing out on here that in addition to that 20 million square feet, there's nearly 40 million square feet of office construction in the pre-construction period, just being planned. Now, there may not be much of that actually gets started, but some of it will for projects where it makes some sense. And there's also, some of that is already pre-leased, so there's already tenants waiting for new buildings to come forward. So some of it will come forward, but nonetheless, it's a continued part of the risk that there's a huge amount of space in this kind of pipeline. I want to switch a little bit to retail and talk a little bit about the demand factors. I mean, people might think that retail is in, really dire shape, and we certainly have heard a lot about that, but it's a more complex answer than that. Retail spending actually is very robust right now. Retail spending certainly took a hit during the lockdown period in early 2020, as you can see there. In fact, it fell quite precipitously for about 3 months in a row. But since that point in time, it's bounced back very quickly, and in fact, through most of the second half of 2020, we saw retail spending on a month-by-month basis well in advance of its normal levels or where it had been a year before or 2 years before. And the first 2 months of 2021 has continued that same trend. We see retail spending up very strong in February, in particular, January and February combined, very strong, much stronger than last year and the year before. So people are spending, but they're just not spending inside stores as much. Obviously, there's a lot more online shopping that's taking a chunk of that purse. And again, post-pandemic thinking, there will be, a bit of a reversal. There'll be less of this spending going through online channels, more going through bricks and mortar channels. But the retail sector itself, it's kind of, has been in the midst of transformation between bricks and mortar and online for quite some time, and this just really represents a continuation of that. It may have been an acceleration, but a continuation. Bricks and mortar stores, for instance, often serve as terminals for for either pickup or even just transfer of goods that are bought through online channels. And so there continues to be, a life for bricks and mortar retail going forward. It just may not be exactly on the same path as we had prior to the pandemic. One thing I will say, I was talking about retail there, but if you want to look at restaurants and bars, it's a much different story. I mean, this is a sector which, it has been literally decimated in terms of the, level of spending on it in some components. It fell in April. It started to recover in the summertime as there was a lot of kind of patios and so on and so forth across the country. And then in the fall, it started to decline, and it's been very, very weak in January and February. On the right-hand side, there's a little bit of differentiation. Obviously, all components of the food services sector have seen extreme declines in revenue, but there is a little bit of differentiation, less of those decline amongst kind of quick service foods, fast food, where they've been able to pivot very quickly to the takeout and delivery model, and for full service restaurants, a lot more of an impact, and for pure bars, a much more severe impact, as you can sort of see coming through that thing as well. So I suspect, again, post-pandemic, that these numbers will reverse very, very quickly. This will be one of those examples where we see things come back very quickly, but it has to be more of a full recovery before we see that come back quickly. So the timing of that is pretty hard to do. Plus, there's going to be capacity issues, right? We have lost a lot of companies that, a lot of restaurants, a lot of bars have closed, and a lot will open very quickly when things come back as well. But the turbulence in that sector may also play to the ability to confidently invest in and build new space, which is sort of what we're concerned about here in that restaurant and bar sector. This whole thing might have really set us back again, probably 3 to 5 years 3 to 4 years in terms of our need for hospitality space. And so we need to bear that in mind as well in the construction forecast. On retail sales, I won't go through this, but just to sort of say that, they are up 6% overall so far this year. They were down on a year-over-year basis last year, but as you saw, that's just the composition of it. But overall, it's still varied quite a lot. Clothing and apparel still very, very weak in comparison to what it was before. And you can see there's a distribution of experiences for other types of goods. Mostly, I just want to focus in though on the one which is building materials and garden supplies. That's the one which is surged ahead, and of course that's driven largely off of the renovation sector and off of the DIY sector. So I'm going to share some comments about those sectors in a couple of minutes, particularly when I get to the residential section. But anyway, bear in mind that one of the upshots of the renovation surge that we've been having lately has been this, almost 30% rise in the beginning of this year over last year in terms of sales through the Home Depots and Ronas of the world. So anyway, bear that in mind as well. I just want to switch back to office for a second just to underscore some stuff. I have showed you this chart before, and it does help us to understand how conditions are deteriorating in almost every market. We continue to have actually better conditions in Halifax for some reason. That's been a trend throughout the pandemic, actually, where things have actually improved in that one in terms of the office performance anyway, but in every other market, particularly the markets of Vancouver and Toronto, which of course are, well, and along with Montreal are our largest office markets in the country, and all three of those have seen fairly significant deterioration in financial conditions. So here we're looking at the vacancy rate. Vacancy rate of around 15% in Toronto is something that hasn't been seen since the early 1990s, and can be a troubling sign. And this, of course, is kind of real vacancy as well. This is this is the availability of space. This is ready to be leased right now, so empty space. Another view of that is a sublet space. And so what component of that empty space is sublet space? And sublet space, just to kind of tune you in, is where if I'm a company and I have a head lease for 10 years on a space, but I no longer need that space, I'll try and lease it out to you, and rather than the landlord leasing it out. And so this is when this indicator turns this much, this is really a sign that there are widespread number of companies or tenants across the stock that are reducing their own space needs and therefore have additional surplus space that they're trying to find a subleaser for. And so the fact that these are turning up so quickly across the way is really a pretty cogent view into the post-pandemic world, in the sense that we're looking at companies that are now making 5 and 10 year decisions ahead and saying, we don't need that space. So this is an indication that we might see a prolonged period of reduced office need, particularly again in those larger markets, the ones that drive the national numbers, Toronto, Vancouver, and Montreal. All of those markets, particularly Toronto, have seen very sharp rises in the sublease market, and that's something to bear in mind. I'm going to switch a little bit, starting to switch a little bit more now into households. Population growth, obviously very important for all activity in the residential sector, whether it be renovation or new homes or home sales. And this is, of course, one of the hallmarks of the pandemic period has been the very, very sharp reduction in the rate of population growth. And I'm showing Canada, I'm showing a couple of our larger provinces as kind of examples. I didn't want to sort of put everything on here and clutter it up too much, but as you can see, the trend is the same almost everywhere. Population growth in Canada overall, we had over 500,000 person growth in 2019, and that was down to under 150,000 person growth last year. That's a dramatic change. And think about it, population growth drives household need. And so if our household need is typically around 200 to 250,000 households per year to support 500,000 people, then we need a lot fewer houses to support growth of 150,000 people. So the longevity of this reduction in population growth is a very germane question as we try and think about post-pandemic period. Obviously, it's the migration component, the international migration component, that darker bar, which is driving this change. The births and deaths component, natural growth, is typically very stable. So it's really a question of how fast migration comes back. And on that question, the news is pretty good. I've been tracking just one component of international migration. There are others as well. But one of those components, which is a pretty important one, is the admission of permanent residents into Canada. And we've got this data by month, so you can certainly see how, in April of last year, it turned almost right off. We stopped admitting permanent residents pretty much completely, except for a handful of cases, and then it was really, it did vary month by month, but significantly weaker than normal numbers through most of the second half of the year. And the good news is that when you look at the beginning of this year, we actually have admission of permanent residents now back, at least in January and February. I think once we get into March and April, when we started to get the travel restrictions put in place, we'll see this number softening again. But at least in March and January and February, when conditions were still fairly open, we saw this number actually return pretty strong. So there's more troubled waters ahead, I think, in terms of the pace with which we'll have international migrants coming to Canada over the months ahead. But I think this is an indication that when conditions do get better, the tap will turn on again. And we have had indicators from the federal government that they're going to be using their policy environment in order to try to boost international migration as much as possible, at least in the short term, when things are safe to do so. And they've done so already with one policy measure, which is to accelerate the rate at which non-permanent residents who are currently in the country can apply for and get their permanent residency. And so that would include students and some other factors like that. And that's the first measure. And they have also talked about upping the targets for just new intake as well. So we'll see how that all plays out. But this is a kind of a cautionary and a good news story as well as we go forward. So I just want to transition now into residential components of the construction sector. And the first, of course, is renovation. And I'm starting with this because it so dramatically shows pandemic effects at work. We saw renovation activity drop quite precipitously in the second quarter as many renovators were not allowed to attend to their sites. Many homeowners were not contracting renovators because of lockdowns in those early months of the pandemic. And then as we moved through the summer and fall of last year, conditions opened up, protocols were put in place in order to get work done. And more importantly, and perhaps, well, importantly, and perhaps more importantly, is homeowners' desire for renovation started to explode. And that came obviously those came from some obvious pandemic effects, including, the idea that we're just sitting at home looking around at our four walls and figuring out what needs to be done. We're doing a lot more of that than when we were going into our offices. Secondly, massive amounts of Canadians found themselves working at home and wondering about how long that might last, in whole or in part, and thinking about ways of fixing up their homes in order to work in them better. And thirdly, people just had some time on their hands, and time on their hands for a Canadian typically doesn't take long before having time on your hands turns one's thoughts to DIY. And I think all of those things were at play as we went through the latter half of last year, and the beginning of this year is no different. Activity is very, very strong. Now, this is having a big implication. I mean, we're seeing prices of materials going through the roof. I mean, the price of lumber has nearly tripled as we go through this period. As a result, almost excludes. Well, I mean, there's a number of factors on lumber demand, but a lot of it is a lot of factors on lumber price. A lot of it is the demand that's coming from the residential renovation sector. I'll kind of remind you that. I did say earlier that amongst residential construction, renovation represents about almost 60% of the overall spend, but it's almost a little over 70% of material demand. So about 70% of materials that go into residential construction flow through the renovation channel rather than new home construction. And so when it starts to surge, it really does have an impact on the balance of supply and demand balances in some of those materials sectors. I'm not going to spend time on this chart, but just to maybe you just kind of like gloss your eyes over to the right-hand side. But it's basically sort of to say that, when you're looking at activity last year on renovation, I mean, there were declines on the year as a whole, almost all the way across the board. Oddly, in the prairies, not so much. We saw residential construction up in Manitoba, Saskatchewan, and Alberta, although from low levels. It had been lagging in Alberta. And non-residential construction as well was up in the prairies. But almost everywhere else we saw residential and non-residential down last year. And almost everywhere we see residential up this year and non-residential continuing to be down, and down by fairly large amounts. I mean, 15 to 20% across the board so far in the beginning of the first quarter of 2020. We will have our next National Construction Activity Report that we produce for CIPH coming out just in about 2 weeks' time. Actually, we're producing it on the 15th of this month, so it'll probably come out a couple days after that, and that will have the data up until March, the full first quarter of data in it, and then we'll have a pretty good idea about where we're going in terms of these numbers for the rest of the year. I don't want to say too much about interest rates. They are what they are. But what I will say is that the sharp decline in rates that were evident early last year, right after the onset of the pandemic, were largely responsible for the surge in, first of all, in renovation spending, because a lot of renovation activity is financed, and secondly, in terms of new home or resale home demand. Because the sharp change in interest rates really changed the profile of affordability for a lot of potential home buyers, and that showed up in terms of home buying activity in the summer and fall. But what I will say, and why I have this here, is that rates are starting to retrace. On the bond front, they've entirely retraced. All their pandemic effects are out. And on the mortgage side, we're about halfway retraced, but continuing to rise. And so a lot of that pandemic stimulus, that would affect both renovation and new home demand, at least on the financing side, pretty much is on its way to retracing. And I think those are important factors for us to remember. And then I just want to move on to home sales. This is a resale market because it gives us a good indication of the way the sentiment of housing across the country. 2020 was our strongest year for resales ever in this country. and that's a pandemic year. I started off in March and April. I would never have believed that this could have been the case, and this is really the way that it played out. Really, really quite remarkable, and that momentum continues. The first quarter was the very strongest first quarter we have ever seen, and by a mile, as you can see there on the chart as well. Very quite remarkable. And perhaps, you know, if you look on the right-hand side, just to think about that monthly pattern of sales as well. I've talked in other data that I put up, or other sectors, or other, you know, economic aggregates that I've shown you so far in this talk. I've talked about how there's been a real uneven activity. I mean, you know, you look at those employment numbers, you look at the hours, you look at even retail sales and others, like you've got some months that are stronger and some months that are weaker, even migration, everything. And yet that's not the case with home sales. It started to come back strong in June, and it's been strengthening, almost a record, you know, performance in every single month going forward. Perhaps only November was there a step back, and it seems to be immune from the second wave, and it seems to be immune from the third wave of the pandemic, even though the first wave obviously had an impact. So, you know, this is something to watch. There was a lot of stimulus that came from, I guess, pent-up demand, at least from the initial thing. There are demographic factors that are pushing young people into, well, not so young people, the older millennials, let's just say, away from their apartments and towards single-family homes. And the pandemic really released a lot of that underlying demographic demand. The sharp change in interest rates improved the affordability situation, at least in the short run, for a lot of potential buyers, and all of that contributed to what we've seen over the last 12 months, in terms of 9 months, in terms of this really surge in home sales. Now, prices have, you know, changed very dramatically since then, and I'm showing you that now. Across Canada, I mean, I can't think of the last time a national number was plus 20%. We've had certainly multiple markets, small markets, where it has been, but for the national number to be plus 20% on a year-over-year basis is unprecedented, and it's a all boats rising with this particular dubious tide, I should say, across the country. I mean, no market. I'm showing a scatter plot of markets coast to coast. Everything is up on a year-over-year basis from the price level. And prices, of course, in housing, maybe I don't need to remind you, it's all supply and demand. I've talked a lot about the demand factors, but the supply factors are what's leading to these crunches. Housing supply is what we like to sort of call inelastic. You can't just produce a house instantly when demand shows up. If it's a new unit, sometimes it takes years to plan for that unit and then to get it built and everything. And if it's a resale unit, there's only, you know, you got to find a willing buyer, it's a willing seller out there, and that doesn't turn on a dime either. So when you get these surges of demand, you'll always get some spiking of pricing. And some of those spikes will come back down again as supply starts to adjust in one way or the other. But right now, we're definitely in that spiking kind of period. But if you look on the right-hand side, part of the underlying story on this as well is that real shifting in demand preferences between, condo apartments and single-family homes. And it's the millennial generation we're watching very closely here, because, you know, it's, first of all, it's a large bulge going through the population. It's a generation that drove a lot of the condo apartment demand while it was strong in the late 2000s, early 2010s, mid 2010s, and now that tide has really turned on that. And I think the pandemic has released a lot of that underlying demographic demand. But you've got your oldest millennials approaching 40 now, and we know, I mean, you can go back to any period of time in Canadian history. I mean, you know that once people are in their getting into their late 30s and early 40s, they are, 65, 75% likely to be, in a single family home as opposed to an apartment. So people are making that move, and that's showing up, and that releasing is showing up in terms of the price pressure. The price pressure is all on single family homes, not so much on apartments. I will note that the condominium apartment numbers I'm showing, just Toronto and Vancouver, which are two important markets for that, are not below water. It's not a market that's in a lot of distress, but there's certainly a lot of the wind has come out of those, or a lot of the air has come out of those balloons, and we're not seeing a lot of activity right now in that apartment side, but it is more of a single family story. I did hint at that at the beginning, about the about new home sales and how we can kind of use them in order to get a good sense. I will stress that new home sales, I mean, they're only generally about 1 out of every 6 or 7 home sales that take place. I mean, most home sales are resale. The resale market is the majority of the way people buy their homes. But new homes obviously play an important role in terms of contributing towards housing demand, because that's our building of the stock. And as our population grows, we need to build the stock. And obviously, it's important to us who feed in, whether it's economic analysis or whether it's plumbing and heating or air conditioning units into the market. You're concerned about the building of new stock as well. And so new home sales, which typically, well, in many cases, well in advance, or happen well in advance of the actual construction, give us a pretty good leading indicator. And they also give us an indicator about some of these trends. And so I spoke a little bit about the single family versus apartment shifting going on in the resale market, very evident in the resale market, and that's also the case in new homes. So we're looking just at Toronto numbers here. I mean, once we start talking about new home sales, it is very much a local story. So we have to look at different localities, but Toronto is an important and large home sales market. This is the Greater Toronto area, so broadly defined geographically, but very strong activity last year, just under 40,000 units. You can see that's not the strongest year ever, but it was stronger than 2019 or 2018, and that strength has continued into the first quarter, where we saw almost 11,000 units sold just in the quarter alone, a little bit stronger than it was last year. But all of that strength is really coming through on new single family home sales. And you can see it was 17,000 last year, over 5,000 in the first quarter, which is well in excess of the first quarter of last year. And on the flip side, in terms of condominium apartments, still represent about half of the sales, but nonetheless, it's really coming down from those highs of a few years ago. And that, slowly declining momentum as well is moving into the first quarter of 2021 on apartments. So it really is kind of reinforcing some of that story. Now, the new home sales have been surging on the single family side, but supply is very, very tight. We have less than a month of supply in the Greater Toronto area as an example of lots to sell. I mean, if you don't have a lot that's approved for sale, you can't sell a lot, and if you can't sell a lot, you're not going to build a home for a home buyer. And those lots are down to only a month of inventory, and you can see that's what's had that big impact on price. So we have prices pushing towards 1.5 million for a new single-family home in the GTA. We saw prices accelerate a lot back in 2016-17 when we had another supply crisis, and we thought things had we turned the corner and things have gotten a lot better since then. But the pandemic and the real surge in demand for single family is really showing up in terms of draining those inventories. I won't spend a lot of time on this, but I do find this one very interesting. This is just kind of 4 different views of the pipeline towards getting that supply. So in order to get supply of homes to sell, first of all, you have to have a housing project. You have to have a launch of a new subdivision, and so that project has to come forward, or either a new subdivision or a new high-rise project. You have to have that project has to get approved, and it has to come forward, and then the lots can be sold, and then we can build on them. And this is showing that on the low-rise side, only 37 projects came forward in the first quarter. In fact, if you kind of look over the last 3 quarters, it's only been about 140 units in total that have been 140 projects that have come forward, and those 140 projects have accounted for about 5,000 lots, and we sold 5,000 lots in 1 quarter alone. So it's showing how the pipeline just is not strong enough to bring new projects forward fast enough for people to buy. So that's a little bit of a risk factor. We see a lot of demand for single family, but we're not going to be able to supply them quite as fast as we want. I will say that land sales, like underlying land sales, this is an earlier part of the pipeline, have been accelerating. There's almost there's almost $5 billion worth of land sales in. Sorry, I'm going to back up a second there. This is not the land sales. This is now Vancouver, and this is now unit sales. And so in Vancouver, we've seen a similar trend last year. started to build a lot of momentum into the end of the year in terms of the number of unit sales, home sales in Vancouver, and it was strong for single family, but also for the apartment product. So a slightly different story than what we saw in Toronto. But part of that is because actually the high-rise product in Vancouver was very weak for a couple of years. I'm only showing the last kind of year and a half of data here, but if you go back 2 or 3 years, it was stronger before about 2018 in terms of that high-rise product, and it kind of collapsed, and now it's been building back up again through the pandemic. And then, but on the supply side, you know, similar story to Toronto. We've seen those. That's the same. Anyway, the supply is also constricting for Vancouver. I just want to share a thought about construction costs, which create a real risk for bringing housing forward right now. Now in Toronto, I'm also showing commercial on here, so whether it's apartments or singles or even commercial construction, even though commercial construction isn't a lot of strong demand for it right now, we are seeing spillover, I think, from residential, and it is posing a risk for commercial construction as well. But with costs that are in that kind of 15 to 20% range on a year-over-year basis, that might be a spike that we, you know, would expect to turn around pretty, you know, over a while. But some of this is materials, some of this is contract cost of trades, et cetera, and some of it is the excess cost of compliance with social distancing measures on site and the like. A lot of it is supply chain interruptions on materials. And everything points in the same direction. It's a big cocktail of factors. But the main thing is coming out of it is a big risk. We could have all the demand in the world for new units, but if the cost gets so prohibitive that it's hard to plan for, to build, and to sell those units, then that creates a bit of a risk for us. I'm showing that Vancouver is a similar story on construction costs for residential, but not so much on the commercial side. So it does vary a little bit across the country on that side. So now I'll just finish off with the forecast. Forecast is usually at a high level anyway in your publication, and this shows what we're talking about. We're looking, if you're kind of on the right-hand side, 2021, we're looking at pretty close to about 240,000 housing units. It'd be quite a strong year. I mean, I think I didn't actually count this up, but I would say that you know, if I had data going back to the 70s or so, this would be sort of one of the 5 highest years of residential construction as a result of that. This graph kind of shows 5 bars at the beginning on each of the panels to give you 5 years apiece, so give you a 15-year time frame, just to sort of show that, you know, where our typical production of housing is, which is somewhere, you know, in around 200,000. And over the last 5 years, you can see the individual years there. It's also been kind of nudging up just above the 200,000 up to the 210,000 range. But on the left-hand side, very much you see those stark changes. So as we move from the early 2000s through to, you know, the most recent data, we've seen this real trend from apartments being a kind of a small minority of production across the country, up to, you know, being the majority in the last couple of years. And really my forecast is for that to kind of very slowly turn around. It's still mostly a 50-50 side of things, but really started slowly turn around. We're going to see some of these trends on single family that I've been speaking about really kind of take root. We're also going to see slightly broader locations for housing demand as well, with some of the you know, continued pandemic effects, which has seen migration of some home buyers, some people in general moving from more dense urban centers to slightly outlying ones. That of course, you know, creates a need for housing in those outlying areas. It creates a need primarily for single family housing. We're going to see that take root. So I won't go through this, but allow you to just kind of take a look at it, and I might leave it up just as we move into questions, because it gives a sense of what we're looking at province by province in terms of the housing forecast right now as well. So Sarah, maybe I might just turn it back to you, and I know we're getting near the bottom of the hour, but if we've got a few minutes for questions, I'm always happy to do so.
Great, thank you so much, Peter. Like Peter said, if you have any questions, please feel free to type them into the questions or the chat box on the right-hand side of your webinar control panel screen. We do have a few questions, Peter, that I did send you before the webinar.
Yeah. So I forgot to. No, I didn't forget to address them. I forgot to address the fact that I was going to address those. Those two questions had to do with when are people going to fly on airlines again, and the other one was when is the border going to open? And I must say it's beyond my expertise to know. I mean, but the answer to both those questions is, very much about the longevity of this health crisis. And while we all kind of expect it to get better with vaccinations quickly or whatever, to be able to peg when the federal government will alleviate border controls, whether that's in the months ahead or whether it's not until next year, that's a difficult thing to point to now without having a good sense about that path of the virus and the variants and all the rest of it. So I would say, think positively and plan conservatively on both those fronts.
While more questions are coming in, I just wanted to reiterate that the presentation is being recorded and will be sent to all attendees afterwards, along with a survey. So just look out for that within the next couple of days. But we are having some questions come in, Peter. First question, why the higher increase in costs for commercial construction in Toronto than Vancouver? What factors are increasing Toronto so much more?
Yeah, I'm not certain if I know the answer to that. I was a bit surprised by the data myself on that front, and I have been having some conversations with some of the cost consultants to try to drive underneath that hood a little bit. But a lot of it really comes down to the pricing power of the trades. And in Toronto right now, there's just so much activity on the residential side that it's drawing a lot of the trades in, and I think that leaves more pricing power for those trades that are continuing to be in the commercial side. And in Vancouver, until recently, like until the last few months anyway, the high-rise residential side has been a bit more subdued in Vancouver for a few years, and I think that there's less pricing power by some of the trades, and that will spill over into non-residential. That might be about as good as I can say on that. I think those are factors that play into it. Certainly, and the questioner might be assuming this as well embedded in the question, certainly to the extent that there are, building materials price increases that are leading to some of these construction cost increases. And we know, even on the non-residential side where wood isn't such a big factor, we know that copper is through the roof right now. Rebar prices are very high as well. And in fact, any steel product is elevated. So, you should be seeing those show up, but a lot of it really does also have to do with the pricing power of the trades.
Another question, Peter. When do you believe the condo market will rise?
I don't know if it's ever going to really rise again. What I will say, and I won't make this too market specific, although, I mean, when you're talking about the condo market, you are mainly talking about kind of Toronto and Vancouver and Montreal primarily, and then to a lesser extent, kind of Calgary, and then some other, Calgary, Ottawa, and some other mid-markets. What I will say is that Canadians generally don't live in owner-occupied apartments. That's not a characteristic of Canadians. It's never been a big characteristic of Canadians. We went through a period in the kind of late 2000s, and almost an aberrant period, at least statistically speaking, where we did see a kind of a rise in those oldest millennials buying apartments, basically. And that was when there's a fair amount of affordability in the condo sector. And that was sort of the first time that we've really kind of seen that, and that drove a lot of trends. But of course, they've moved out of that trend. The younger millennials didn't take up the condo ownership trend in the same way. They responded very much. They acted more normal for their age and rented, and that's been driving a lot of the rental demand lately. And Generation Z is coming through, and there'll be a rental generation as well, just because of the affordability issues on condos. So I think that if you're planning on a market full of owner-occupied condos, that's not a thing we're going to see a lot of demand for. Now, on top of that, what has been important over the last 15 years is the fact that the condo market supplies a lot of the rental market, and that's done through investor condos. So that's been a huge chunk. I mean, that's like in Toronto, that's been 2/3 of the market at times. And that part has been important, and that has been a big driver of condominium apartment projects because they sell out to investors or largely to investors, and then investors rent them out. And we have had a lot of rental demand. Rental apartment demand has been on the upsurge for the last 15 years for a variety of reasons. But what we are seeing in many markets now is that the emergence of professionally managed purpose-built apartment buildings is now growing strong. So, we had more than 6,000 new apartments come to market last year in Toronto, for example. Now that's representing a pretty big chunk of the rental demand. So we're going to see this continued shift where rental supply is going to come more through professionally managed rental properties, less through the investor channel. And so both of those things will spell less activity and need in the traditional condo sector. We don't have as many owner occupiers, and we won't have as many opportunities for investors because they're competing more heavily with the purpose-built sector. And those comments apply to Toronto and Vancouver and Montreal almost equally.
So we do have quite a few questions to go through. I'm just going to let everyone know that we are going to be going to about 2:45 Eastern time, and then afterwards I will connect with everyone and make sure that Peter is able to answer all the questions that you have. The next question, do you have housing completes estimates?
Yeah, actually, I don't have those in front of me. The completions is what we say, and these are, I mean, in our forecast, we typically talk about starts. So that would be when a construction of a home or an apartment gets started, and a completion is when it's finished and ready for occupancy by an individual. And so, depending on what product you're selling into that process. I mean, if it's concrete, it's generally you want the start because that's usually when your product is being consumed. And if it's drywall, that's usually somewhere in this in the middle. And if it's a plumbing fixture or something like that, that's generally very near the end. So in our services that we provide to the industry, we have our construction starts publication, and you're looking at a page of that right now that I know a lot of you probably subscribe to already. We do a high-level summary of this in the quarterly document we send out to you guys. But this is a very detailed document on starts, and we have a similar document as well that looks at the same kind of breakdown, but by completion. So that's certainly all done, and we estimate that out based on the typical time frame for construction for the different types of units and in the different markets. They each have a different formula.
With supply chain disruptions and product shortages, are your housing forecasts taking these issues into consideration?
Well, I've used the word risk many times when I was giving those forecasts, and that's basically what risk means, right? A forecast is a best guess where things are going to go. So we've got demand, we've got supply, and both demand and supply, there are risks around it. I mean, the demand risks right now have to do with affordability because prices have changed so quickly, and the supply risks include those costs that the questioner is asking about. And so this is a kind of a best guess of how it will play out. I guess to give you sort of an example, I have this surge of construction this year, as you can see, at about 240,000 units. Then I have it going back down to what you might call a kind of a normal number, but it's, anyway, we back down to around 215,000. And I think that if there were no supply constraints right now, that if we could just bring on, any amount of construction to meet demand, that we would have those numbers in excess of 240 now for 2 or 3 years, because there is a lot of pent up underlying demographic demand. So I would say that those supply constraints, the idea that it's hard to bring lots forward through the pipeline. I tried to kind of, illustrate that with an example in Toronto. It's hard to ramp up supply chains of materials in many cases. Labor can be an issue on construction as well when you're trying to ramp up. And I just simply don't think that we've got the capacity to build, 240,000 units in Canada consistently for very long. So I think those risks are embedded into the forecast.
Another question. This is in regards to the new home build sector. Do you think that the supply and demand issues will persist? If it does, will that lead to large amounts of inflation?
So is the questioner asking about housing prices? Is that what they mean by inflation, or do they mean inflation across the economy, like like for goods and services?
I'll have
like
to
inflation the way we think about it, like with at the grocery store and everything. Is that what they're asking about?
We'll have to clarify. So we'll see if the questioner.
Well, I'll address housing prices to begin with, and then I'll address both then, if that helps. No, the housing price thing will not continue in the way that it is. Some of that plays to what I was just sort of speaking about, that that it's a bit unsustainable to it's a bit unsustainable anyway to continue on with such strong demand with these supply constraints. That's what's creating the price increases, and the price increases themselves are a result of those supply shortages, right? So eventually what happens is, prices increase enough so that, affordability just chokes right off for the average buyer. Interest rates have risen, as you know, so that's contributing towards it. And then we'll see that kind of pull back, at least until affordability improves again. So, I can't, it can't be the fact that if you thought housing prices going up 20%, that you're going to have, 2 more years in a row of another 20 and then 20, because there's no way that housing can consume that much of people's budget, basically. Like, that's the one way to put it. So I can't see, I usually what happens when prices go up is something breaks and the markets adjust in some way. We hope that adjustment will be a kind of what we call a soft landing on prices, which is that they just kind of flatten out for a little while until market fundamentals pick up again. But it can also mean market adjustments going down. You could have prices falling, modest amounts as well. I will address just the general inflation question. I don't know whether the questioner was asking about that or not, but I didn't speak to that. But it is actually a topic of discussion right now. There are, we are starting to see the inflation numbers pointing upwards because of the, the rapidity of the economic recovery. And we have a thing right now in terms of data which are coming out recently on inflation and that will affect us for the next several months, which is called base effects, which is to say that, all inflation numbers now are this month versus a month a year ago, and a month a year ago was in the worst of the pandemic. So a lot of prices, like for gasoline and others, you might remember, were quite low. So that will make inflation look higher than it actually is. But the underlying drivers of inflation, which are usually like consumers' expectations and workers' expectations for wages, we don't see those inflation expectations there. And that's usually what drives up long-term, underlying inflationary pressure. And that's just simply not in the works. So we've got high prices for assets right now, and that would include houses and stuff like that, and stock market. But we also have deflationary effects on, a lot of goods and certain services and stuff like that as well. So overall, inflation expectations will continue to be, more in that 2% range going forward.
I'm interested in forward-looking projections on the Canadian dollar and associated tailwinds.
Dollar has been surprisingly stable through this pandemic, I must say. I mean, I think I would have also expected it at least to have a lot more fluctuation. We've seen a little bit of a rise just and a little bit of strengthening in the dollar just in the last few months, but it's been very, very stable. I don't call the dollar, and that's why we don't show it here in terms of our forecasts. I consume forecasts like anything else. But the last time I looked at my kind of consensus of bank forecasts for the end of 2021 and end of 2022, they continue to still be in that 75 to 80 cent range. on the U.S. dollar, and it's showing a lot of stability. So you can kind of take that for what it's worth, because I find that dollar forecasts are always that way. They always just kind of gently trend up or gently trend down from wherever they are, but never. But the reality is that usually when they do change, they change in spikes. But anyway, what I'm reading right now is that it's mostly a stable dollar. There's not a lot of shift in the dollar in the cards right now. That's not a major concern that economists have.
Are there trend of changes in construction regulations derived from COVID lessons learned?
I don't know if I'm the expert on that. Although it's an interesting question, and I think it's probably something I'll try and look into. I think what the questioner is asking about is, I mean, we pivoted our construction sites very quickly about a year ago towards COVID safe practices. And I'd say at 95% of the case, or 99% of the sites, I think that they have been very safe and conducted that way for the demands of the disease as we knew it at various times. And those practices have migrated as we've changed our understanding of the disease. I think that if we get into a post-pandemic world where that particular infectious disease is no longer of any concern, then we're back to, just worry about general infections, and we don't tend to have a lot of worry about that. So, will construction practices all go back to the way they were, or will some of these pandemic safety measures continue to be in place? I suspect it's one of those cases that most things will start to revert, back to where they were. But but some of if there were innovations that were brought in, particularly if they were technology oriented, like for instance, use of technology in order to better schedule the pace at which trades come onto the site and interact in the units and stuff like that. There has been a lot of gains this past year on sites, in terms of using technology in order to do that kind of scheduling, etc. I suspect some of that will still continue to be in place because now that technology is in place. But I suspect most practices will kind of go back to the way they were before, as that's the way, those are the tried and true techniques.
This will be the last question that we're going to cover today. If your question did not get answered, you will be receiving an email from me, so that way we can connect you with Peter to get your question answered. The last question for today is, why the big fall off in 2022 on single family starts in Quebec?
I think the question should be, why the big ramp up this year? And actually the fall off is you can sort of see all the way across. It's a similar, I mean, Ontario is pushing out a little bit further. I think there's going to be a little bit more legs to it. But in general, I think that some of the pandemic effects that have pushed people from urban centers out to more outerlying areas have put a lot of pressure on the need for new homes in those areas, particularly single family, and that's pushing up those construction numbers for single family, and that's showing up particularly in Ontario and Quebec this year. I just think that a lot of those Quebec municipalities are going to be more successful at bringing forward those homes in this time. A lot more use of modularization in Quebec. Supply does tend to respond more quickly to demand in Quebec. There's not as stringent, particularly in the kind of markets we're talking about, not as stringent building controls as we have, for instance, in the growth plan in Ontario. So I think that it's more that we've got this surge in demand in both provinces, and more of it's going to be built in Quebec right away. More units are going to come forward, and then it's going to get back to a more normal level after that. Whereas in Ontario, we'll probably see about a year and a half of elevated single family, and then it'll start to get back to normal as we get through this internal migration effect.
Thank you so much today, Peter, for your presentation, and thank you so much everyone for sticking around for the questions.
Always a pleasure.
As I stated at the beginning of the presentation, a copy of the recording will be sent to everyone within 24 hours, along with a short survey just to let us know how you enjoyed the presentation today. If you have any questions that you think of after the presentation, please send us an email at info@ciph.com, and we will be more than happy to pass those along to Peter. Thank you so much again, Peter, and thank you so much, everyone, and have a fantastic rest of your day.
Bye for now.